Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of July 6, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viperxl007, and we are going to take a look at the further learnings of Viper and the world of options and the stuff that he has bumped into. And they are things that we have all talked about before, but somehow the lesson hits a little bit differently when you actually do the trade and you hit them with real money in real trades, which is what we always emphasize on this show is trade small, get in there and start doing, because that's when the learning really starts to sink in. And so we'll talk about some of those episodes here coming up. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/Sprocket888 as well as /Viperxl007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, before we hop to your learnings that you've kind of been bumping into, I just want to kind of call out an interesting thing that I've been pretty happy and content with recently, that I've one of the things I've been really struggling with, or not struggling with, but attempting to rectify, is the amount of drawdown on my account in any one given time. It's something that in past episodes we've kind of mentioned before, where the market will take a particular move against you and your buying power will really expand and it'll really kind of draw down on your capital, which there's always going to be drawdowns. But one of the goals that I really have here in 25 is to start smoothing out my drawdowns, because fundamentally the way that I trade premium collection, it really shouldn't suffer massive drawdowns away from the return on things like the S&P and things like that. I think they'll always be there, but I wanted to basically reduce some of that volatility. And one thing that I've been trying to do, and it almost was a mistake, but I'm kind of going with it, is I've been really kind of counterbalancing my portfolio deltas with futures contracts. And what I mean by that is I've been trying to be more cognizant of the total deltas that my portfolio has. So think of that as basically the amount that your portfolio will move based on the move in the market. And I like to keep my portfolio basically delta neutral, which means if the market goes up or the market goes down, my portfolio shouldn't move. Why would you want to do that? Well, because my portfolio gains value by theta decay. So as long as I'm not swinging wildly with the market, that really helps out. But through assignment and stuff like that, my portfolio has been building up kind of a delta long bias. So, I sell puts and stuff like that. The stock drops and I end up getting assigned shares, and you end up going long on those in some cases. Well, when you're long shares, you're long the market, and that's basically picking up positive deltas. And so I've had an open short, two of them actually, on the Russell futures, which are relatively large products, and they've been doing horribly because the market has been going up. So, if you look at them, I think they're down 5%, 6% on a ginormous notional value. But my overall value in the portfolio has remained relatively constant. In fact, it's been constantly ticking up, because what's happening is all of my long positions are gaining price share and price appreciation, and that short Russell future is basically detracting from my P&L. And you might think, well, dump it, go back to it. Well, I want to smooth out that volatility. So as we kind of peak up here, my goal is to get out of these longs by selling calls and getting assigned away. And then the presumption is the market won't extend and go up forever, and you'll get a retracement on that Russell. And now that is going to start picking up steam coming the other way. So we'll see how it goes. I've been very, very happy with the reduction in my price volatility of my portfolio thus far. So that's really what I've been up to in the past couple weeks, Viper. I know that that's probably way outside the scope of what you've been dabbling in, but what have you been up to lately?
Uh, well, a couple things. Obviously, the world of crypto never sleeps, so plenty of action going on over there. Um, Plenty of tool build out, plenty of news over there. Which stay tuned if you're into that sort of stuff. Big stuff to talk about. Maybe next week or in a future episode. But as far as equities and options and my journey henceforth there, um, two major things have come to light. One is my pride and joy, my earnings strategy, which I have multiple times on this channel, prided the data driven approach I've taken to that strategy. And it is ironically, but also not. It's also unironically. I think I stumbled into a massive. Um, I don't even know, fleece operation.
Uh-oh. That doesn't sound good.
Yeah, I got taken advantage of, I think. So that, and so for the time being, cutting to the spoiler, I have paused all of my earnings action because this was just that blatantly bad feeling. And I am currently moving to Tasty Trade, not a plug for Tasty Trade, just moving to another broker for that specific strategy for options. And we're going to get into all that in just a second. So I had to fill the gap with something. And I think it would be interesting. I don't think we're going to do it in this episode, but I would like to visit this topic at some point. That I have. So one thing that the earnings trade has done is, because I've been so focused on utilizing the calendar call. The calendar spread. It's really, that's caught my attention. Just in general, the mechanics of the horizontal spread, the calendar spread. It's just, I really, really like it. And I'm very interested to see it in different use cases. So in the meantime, I've stumbled into this daily SPY trade using a calendar spread. Just at a very high level, you take the short option, which is a one DTE, expires the next day, and you take the long option on a 1 week expiration. And the TLDR is that instead of being long or shorting volatility and everything we talk about with earnings trades, this is selling premium on the tail risk of retail behaviors around the 1 DTE SPY options chain. So without getting any further into it, that's been super promising. And I guess I would classify that. I don't know if you've been following along any of the discussion in Discord, Sprocket, but I would classify it I keep calling it an income strategy because it really is intended to just be, okay, boom, 15% or 20% profit, boom, hit it, close it, boom, hit it, close, and it's just a daily trade. So that's been interesting as well.
Yeah, I want to hear more about you getting hoodwinked here on whatever you've discovered there. Talk to me more about that. I have been keeping track of the other ones. We definitely should do an episode on that strategy you got going.
Yeah. So let's introduce the topic real quick by saying, I hear you recently played the FDX FedEx earnings. Just, because I don't think you prepared anything for this, but how did that work out for you?
I made bank on FedEx earnings.
Yeah.
That it was hey diddle diddle right down the middle. I sold a strangle on that thing, elevated volatility, absolute vol crush on that. The price didn't move. I mean, I think I turned 97% profit by about noon the following trading day.
Nice. That is perfection there. And the worst part is, I thought all the way up until market open, I thought I was joining you. I was just as excited as you. Actually, yeah. So let's jump over real quick to the chart just to show everybody what happened here. And yeah, like you said, so earnings is obviously going to be this big spike we see here. Let me make this a little bigger. The green dotted line vertical, that is the earnings announcement. I mean, I'm zoomed in, so it looks like, oh, it fell off a cliff. But let's get our handy dandy measure stick out. And I mean, just post earnings, just the peak of the most dramatic move of it was a 5.6% move to the downside. Fast forward, market open, we opened up and we, went just we wicked just slightly lower than that, 5.7%, and immediately started climbing back up. And so just to toss some lines down as far as your strategy, I don't know exactly where you were, but let's say you were something like this on your strangle.
I was around an 8% move, I think.
Okay.
I can't remember what the actual strikes were, but I recall it was about an 8% expected move that I took.
All right. So we'll bump that just outside because I guess that is important that you were constantly down the middle the entire way. So this is roughly your position here. We're straight down the middle. And that is your max profit scenario. For my strategy, my max profit scenario is similar because basically I need a return to the strike. So dropping one more line here, I take a single strike because this is just a horizontal spread instead of a vertical spread of any kind. And we'll give myself something more visible as a red line. So my strike, I believe, was 230. So I hit max profit similarly to you if we get back to that strike. And most importantly, as long as we don't go far from it. So this moved down overnight into the morning. I was like, this is beautiful. 5% down. I have gotten profit out of much more dramatic moves. And that's, even though I need to get back to the strike for maximum profit. So all things considered, as this unfolded here, I was super jazzed. And it was just a very validating moment for my system. So if I hop over here to why I was so excited, I've been learning a lot, obviously, as I've built out this screening process, data-driven dashboard, all that kind of stuff. I've gone into all these metrics before. There's a few of them that I'm going to revisit now because I think it's important to what I'm trying to point out or where we're going with this. But I was super excited because as as we talked about on a previous episode, quality over quantity every single time with an earnings trade is the way to go. And I have consistently been narrowing my view. And FDX here was one of the first times that it was like, this is quintessential quality across the board. And so what I mean by that is some of the key metrics here. So the price, 228.90. So this was another reason why I was excited, because one thing I learned is previously I talked about how I'm trying to take $100 trades on this account for this strategy. One thing I've learned is that's just not always going to be the highest quality at that price point. So I am opening up a little more leniency to go a little bit higher than that, as long as it's quality. And so I'm kind of redirecting. So we always talk about position sizing and whatnot. I'm still within an acceptable position size window, but I'm kind of shifting my mindset to the quality of the data, because now that I've thoroughly vetted it and audited my data collection and calculations, I'm kind of pivoting to that as my risk mitigation strategy. So that is to say that this was a more expensive option spread than what I've done with this strategy before. But the data points that were just screaming how good this was volume, check the box. I mean, green means good. Green means go. And then next here is the 1.45 IV-RV ratio, which is implied volatility versus realized volatility. This actually spiked up to 1.51 by the time I opened it. And the TLDR on this value just means the higher it is, the more volatility, the more, I'll say quality volatility there is, that is the point of this calculation. The term structure slope was fantastic, negative 0.01183. I think this cooled off only slightly. But again, the steeper, so the more negative this number is, the steeper the slope. And so that means the more elevated premium is on the short month versus the long month. And an expected move, the chain was pricing in a 7.4% move. And finally, the last thing, if I scroll over here, was from our previous discussions about liquidity and liquidity is king and all that foreshadowing. I've spent a lot of time refining this liquidity monitor, this liquidity value here. And so this had an 8.6, phenomenal liquidity score. So I'm stoked. Everything across the board, because so many trades have gone dead because the liquidity score was pretty terrible, if not untradeable. So this had everything across the board. And then obviously the most visible here is my Monte Carlo simulations, 10,000 simulations. And again, this is all like I've spent a lot of time. I'm not saying I've got anything perfect here, but all I want to impress is I've spent a lot of time iterating, honing, and crafting all of this to be as accurate as possible, so that it's not just, running a random number generator. Like the Monte Carlo reads in the expected move, and then it does its Monte Carlo calculations based around that expected move. So it's not just throwing darts against the wall. So the Monte Carlo looks phenomenal. It has a max loss case of negative 19% with a median case of 21%, 75th percentile at 27%. It called for an 89% probability of profit. And the exact numbers were, it was somewhere around 0.24% of the 10,000 simulations lost more than 10% on this trade. I'm like,
so Viper, what the heck happened? All the signs point to yes. What's going on?
Everything.
I'm confused.
Everything looks gorgeous, and I logged a loss.
Man, did you fall asleep or something? What's going on?
It was bad. So on the chart here, we opened. So again, we moved in the right direction on open. I opened and I jumped into the app. Robinhood, by the way. I jumped into the app and I was like, all right, I'm so excited to see this. What is going on? I'm down 30%. What is that? It was a 4.5% move, 5% move at that point. It was within the expected move. The Monte Carlo very well simulates within the expected move. That is not an outlier by any means. And so seeing it down 30% on open, immediately I jumped. I don't immediately jump to close, but this strategy does require closing 15 minutes after market open. So I start shopping for closes 15 minutes after market open, and I'm just getting the worst spreads you could think of. I want to say it was like giving me quotes of $1.50 to $2.20, and that was the spread. So we got like a 50 to 70 cent wide spread on close.
Whoa!
and this is supposed to be the most liquid time of day. And so you can see as the price moved, I do think it would have gotten into profit here midday. But keep in mind, I'm trying to stick to the rules of the trading strategy, and the trading strategy was played out specifically 15 minutes after market open. So it started to move a little bit in my direction. Ultimately, I closed at a 10% loss. So I was in that 0.24% of all 10,000 simulated trades. That feels like a win, right?
Yeah, you're a lucky guy.
Yeah. So this led to a couple of things. One, it led to a very sad time. So what this led to was, first and foremost, was a gut check, or a gut punch, where I was like, I think my system's broken. I think I've carefully crafted this very detailed, tried to be as agnostic to bias as possible system, and this should not have happened at all. I'm not saying it should have been a huge winner, but a 30% loser on open, that is just that is extreme, and it signals something is broken. That is the one ultimate truth in that moment, is something is broken in this strategy. So of course I turn to my system and I'm like, I think it's me. I don't know. And so, so I took a pause. It was very deflating because, I mean, yeah, I'm proud of the system I built. So then midday later,
And I was on Discord telling you how I was making bank on FedEx.
yeah, I was like, I should have just been doing strangles this whole time. What the heck? So, and I mean, that did cross my mind of like, maybe I just need to do Sprocket strategy and, you know, pick my plays based on that. But so mid to late day, then I hit phase 2 of like, all right, I need to know what the heck happened. I'm not just going to turn my back on my system. But this was a clear red flag, as red can be. Something's wrong. So I happened to have a conversation with my LLM of choice, Claude from Anthropic. I already have a chat session open where I've run a whole bunch of different code snippets by Claude in this chat. So the chat has great context of the system. So I was like, that's a great place to start. Let's go talk to Claude. And so I just laid everything out for Claude. I said, here's all the data. Here's, you know, everything. Here's what I paid. Here's what I saw. Here's what happened. And immediately Claude was like, yeah, this is a problem with Robinhood. And I was like, well, okay. I mean, of course you're going to defend the system that I just continued to give you code snippets for, but I asked it to explain, you know, what's the deal with that? And, you know, what I found out was, we talked about this. Brokers matter. You know, not all brokers are created equal. So what Robinhood specifically does is, I mean, people have probably heard, because it's made the news plenty of times, pay for order flow. It's made the news. It's been said in the halls of Congress, pay for order flow. So what Robinhood does, and this is really important, especially for options trading, but it's important for all trading on a platform. Somebody has to fill that order. And so Robinhood takes the order and then they submit the order to somebody to fill the order. Now, what most brokers do is they submit that order to the market and they let all market makers decide and fight over your single order. And whoever's got the best fill, that's the one that takes it. The best price, that's the one that takes it. But in a pay for order flow, that's not the case, because Robinhood is getting paid to send the orders to a specific market maker, Citadel in this case. And so what appears to be happening, and what I've experienced, is when I open the trade, 15 minutes until market close on an earnings announcement day, that is a very volatile time on the options chain. So two things seem to be happening. One is I'm doing a complex options order, which is now one strike against me. And Robinhood has no obligation to give me the price that they're quoting me in the app. So if they say 235, sure, they said 235, but they could do whatever price they want. They could manipulate that price. So I think I'm being smart in my bid. So they say, okay, yeah, the spread is totally 215 to 230. And then I think I'm being smart and I'm like, cool, I'm going to take, cause these are debits. I'm going to take the 215. I'm going to try to squeeze a little extra out of this. And in this exact case, I got instantly filled on the low ball. Now that's flag number 2 is you get instantly filled on the low ball, which should not happen. Somebody's going to fight for that order. And initially the market would see it and be like, nah, I can't do that price. I can't. So manipulated the price display. So I think I'm being smart and I'm like 215. And then they're like, psych, the 215 is actually the ask, or whatever. And I get a terrible price. So there's that. But I think one of the biggest impacts was the close, the market open post the earnings event. I mean, it is a volatile time on the chain. Market makers are scrambling to get everything priced right after a very volatile move. Not super volatile in this case, but in some cases. And I was getting terrible spreads. Like I said, 50, 70, 80 cents wide. And that was maddening because I was like, this should not be happening right now, but I need to close. And there is the rub of what they're counting on. They're counting on people needing to close in that moment of the market open. And now Robinhood has a direct line, or Citadel has a direct line to Robinhood. So they got a conveyor belt coming in, and they're just saying, hey, all these orders coming in on this conveyor belt, literally nobody else is seeing these orders. These are direct to us. And so there is zero competition to fill that order. So Citadel's over. I mean, they're participating in the market as well. So they're out there doing their thing, playing the market, trying to get all the good fills on other stuff, while they have this lineup of just on a platter that they can, when the price is advantageous to them, they can hit the platter tray, be like, yep, I'm going to eat that, and give terrible fills on those closing orders. So the combination of those two things easily eats up 30%. And that was all I was looking for. I mean, I was 15 to 25% was my best case expectation for this trade. How it played out, probably could have even gotten more than that. But the point is, I'm not playing for the moon here. I'm playing for 15, 25%. Easily, really bad execution could cost me 15 to 20%.
It's such a bummer for you, Viper. And to be honest, it's not something that I ever, like, I read about, I talk about, and I don't talk about it, but, I kind of know a little bit about that, but I always like, oh, that's not really a thing that I dabble in. Oh, that's probably wouldn't hit you that much. And then when it really hits you, you're like, wow, that was pretty bad. And I've had bad fills too, and they can really, really eat into your profit potential on a. That's why I always talk about the tight bid ask spread, and you want to basically have that efficient market pricing, because a bad fill can really put a dent in your profitability.
Yeah. And I mean, and to be honest, like, that was part of my mentality before this happened, is I was like, yeah, I know, I've heard all the rumors and everything, like, oh, Robinhood's terrible at this, but I mean, honestly, it's fine. And in my head, it was that mentality of, well, how bad could it hurt? I'm just a small guy making small trades. How bad could it actually hit me? I mean, and some of that I think is semi-valid if I'm just buying a stock or something like that. Like, oh, okay, so I paid 0.25% more for this, but I'm playing for a 10% move or whatever. So yeah, sure, whatever. But I think it's really important to stress, kind of like you were saying, that the price of the spread and the fact, like I said earlier, that all I'm playing for is that 15 to 25%, which sounds like a lot, but in options pricing, I mean, I kind of feel like that's not a lot. Is that, would you agree? As far as, I don't know, I'm trying to equate the percentage to options prices, and I feel like options prices can move a much larger percent, and I mean, every penny matters at that.
No, it definitely does. And I would say your bid ask spread, like, we're talking 10 cents, 15 cents spread, right? But you're talking about that spread on basically an option that's going for $2, right? So that's a huge percentage based on the cost of the option. Whereas, you know, the spread on maybe your Nike shares or something like that, like, okay, you got 5 cents spread, 10 cents spread, but your shares are on the $80 order or something like that. So I think it does make a difference percentage wise of that.
Yeah. So I went into it thinking like, oh yeah, it's fine, but I'll just outperform it. Not realizing the entire measurement of the performance is based on that thing. So, so in hindsight, well, not in hindsight, but you know, that all things considered, it did still to this day has me rattled about my system. I'm not changing the system at all. This week has been a pretty terrible earnings week. Not a lot popped up on the screener. So that was cool. That gave me a little breather. But in the meantime, I've shipped off a bag of cash over to Tasty Trade, like I mentioned. And we're gonna run it back and try another solid earnings season where I do all of these earnings trades over there. And my suspicion, based on everything I've collected so far, is I should very much, without even having to measure things too closely, should very much feel a difference. And then icing on the cake is if that difference starts to show up in my trade tracker and my trade journal, where all of a sudden, hey, guess what? 15 minutes after market open and I closed for a profit. Easy peasy. Like that's what should be happening based on all data that's been run and collected about this strategy. So we'll see.
Yeah, I'm excited to see the analogy I'd kind of that just echoes through my head as we talk about this, right? Is your marketplace is your kind of village bazaar, right? Where you've got your big flea market, you got all these vendors everywhere hawking their goods and stuff like that. And that's the complete and total marketplace. And your brokerage is kind of like your guide to that says, oh yeah, come on in. You know, we got this over here, this over here, this over here. And I think the different brokers, you know, some of them like a Robinhood, maybe they only take you to 2 or 3 of the stalls in the bazaar there. And they're like, yeah, these guys will take care of you. These guys will take care of you. Where the larger brokers or the bigger ones, interactive brokers, Tasty Trade, you know, you're not going to be limited to just those 2 or 3 stalls. They're going to go ahead and you're going to be able to shop your order around to all of the markets there. And I think that's probably a good research point to figure out, hey, how does the order routing go? How do the orders get filled? Viper, I know I was talking to you outside of this show where that was one of the things that I thought was kind of interesting whenever I start trading off the beaten path, if you would, with my options. It tells you what exchange filled your order. You know, my Charles Schwab, my TD Ameritrade, Thinkorswim, they did this too. But Interactive Brokers does it. And I've noticed that whenever I dabble, and I do occasionally dabble in things that have wide spreads, not super liquid, they're more a little off the beaten path type names. They're still big names. Like, for example, Seagate is one I distinctly remember, Seagate Technologies. And I will get an order fill and it'll, you know, say something like, you know, PYX or something PHY or some different thing versus a CME fill or an NYSE or I can't think of the big one, not Amex, but anyway, you can definitely see it. And that was something that was odd. I'm like, oh, wow, cool. Like, that's weird. Went to something I'd never really heard of. And I think it's that whole marketplace availability. So I am really interested to see how it pans out for you. I do think you're going to have a much more positive experience in the world of options.
Yeah. And I think the last thing I'd say, because I think it's absolutely worth driving home, because this isn't about dumping on Robinhood. This is about high school economics. No such thing as a free lunch. And this is about knowing where is the money coming from. So off the top of my head, because I didn't prepare for this, but I would suspect when you compare commission rates, Robinhood probably has a really low commission rate compared to your Tasty Trade or your Interactive Brokers or whatever. And guess what? They're doing that because they're getting paid by the Citadel guys to send the orders over there. So you think that they have this great deal because they're giving you super low commission rates or whatever, but they're still going to make their money. They're not a charity. So if I'm giving them the biggest benefit of the doubt, which is an oversized benefit, it would be that they have chosen to approach their revenue model, their business model in this way where they're still getting paid just as much as their competition because that's how they remain competitive. But they decided to go a very different way to get there. And obviously, as someone who's getting fleeced by that alternative direction, it's not great. It's not something I enjoy, but I can at least, like I said, give them the very large benefit of the doubt to say this is how they've chosen to do business rather than be like, they're just trying to screw me over. Like, no, this is how they're making money. But it's important. It's important to figure this out on anywhere you go, whatever you're trading, especially in the market. There are so many ways to for them to make money that you need to know how it impacts you.
Yeah, no, definitely. And honestly, kind of along those lines, it doesn't mean that you're, oh, well, that's crap, you're getting ripped off. It all goes back to, what are you trying to get out of your broker? What's valuable to you? Where do you get value? That's why we said, all brokers aren't created equal. Some things are better fit for others. I can tell you that one of the big shocks that I had when I went to Interactive Brokers is I was like, holy crap, they nickel and dime me for everything. Like, you want level 2 quotes from all the places? That's an extra $2 a month. Oh, you want this particular news feed? That's an extra $1.50 a month. And there's all these little nickel and dime charges. And you might think, well, Sprocket, that's got to be more expensive. Well, actually, it's not, because guess what they do? They give you heck of good margin rates. Like their margin rates are really low, and they actually pay you really high interest on your cash that sits in there. Well, why are they able to do all that? Well, because they're going to collect their money in a different way. But that's just something like, for me, the low margin rates, that is very valuable to my trading strategy. So I don't mind the extra fees and stuff to get some of those benefits. In net, I come out ahead. That was a big price comparison I did between TD Ameritrade at the time and Interactive Brokers on the total cost of ownership, is what you hear it in a lot of different shoppings things, not so much in the brokerage, but take all of your trading style, your commissions, your feeds and all that stuff, and you add it up to really understand what the cost of that trading platform is for you. Very similar to that, what are the pros and cons based on your trading style? So liquidity and fills and order flow, that might really matter based on your trading style that Viper discovered here. But maybe if you're just going in and saying, yep, I'll take some shares of Apple, thank you. Oh yeah, I'll take some shares of SPY. It probably doesn't matter as much for that type of thing. Well, that brings us to the end of this week's episode. Again, every single one of these episodes, I feel we could really wrap up in a similar way. It's all about knowledge and understanding of what makes everything tick, right? Understand the ins and outs of it, right? So Viper, and the best way to do it is to do it. Start small, trade small, learn the lessons firsthand. They're going to sink in more. The stuff that Viper discovered with his orders and his fills and all that stuff. Sure, they're things that he kind of read about once upon a time, and he thought, it doesn't matter to me. It doesn't matter here. And then when he's actually in it, he's like, oh my gosh, he's ready to pull his hair out. And that's when you really start discovering, and that's when you go and you dig more in, like, why did this happen? Blah, blah, blah. And you ask those questions and you dig in and you start discovering things that you probably wouldn't have discovered elsewhere on your own. And honestly, if you did, you probably would write them off because they have no relevance to your current perspective and things like that. And so that's why it's so important to do this journaling, do this, inquisitive nature of going after this, because there's a whole lot of things to learn out there. I have so much more to learn about trading. So does Viper. I don't think we will ever be done learning about it. That's what I think makes it super exciting, because you're constantly ingesting new information and expanding your knowledge and learning new things. So hopefully you are engaged in that type of activity as well, and hopefully you find it interesting. Feel free to reach out to us and let us know what you want to talk about on this show, and we will bring it up and go through it. Otherwise, Earnings season is just about ready to get kicked off here in a week or two, and we're going to start cranking, and we're going to go from 1 or 2 earnings trades a week to 1 or 2 dozen to potentially up to several hundred in a week at the peak, and that's going to be a lot of fun to see how all that pans out. So good luck out there, have fun, and remember, think outside the block.